Well, hello everyone. In this particular recording, we're going to go through our homework for Chapter 11. In Chapter 11, we were talking mostly about bonds. Remember what bonds are. Basically, bonds are when the company goes to the public and asks to borrow money, but that money, of course, is the principal that needs to be paid back plus interest over the bond term. Now, there are different ways you can issue bonds. You can issue bonds at par value, which is basically when the interest rate of the bond is the same as the interest rate of the market, or you can issue bonds at a premium or a discount. And this first exercise, 11-3, deals with issuing bonds at a discount. Basically, what issuing bonds at a discount means is we are going to collect less than what the face value is of the bond. And the reason for that is because the interest rate of the bond is less than the market rate. Effectively, where the investors can get interest elsewhere is higher than what we're giving them. So the only way we can sell them is if we put them on sale, effectively selling them at a discount. Okay, so if you open your textbooks and you go to page 549, you will find exercise 11-3. We have a company, they are called Chin Company. They issued $10 million of 5-year 7% bonds to finance its operations of producing and selling home improvement products. Interest is payable semi-annually. The bonds were issued at a market rate of 8%. So because the market rate, meaning everywhere else, they can get 8% interest, but we're only going to give them 7%. The only way they're going to buy our bonds is if we sell them at a discount. And so we were able to sell the $10 million bonds for a total cash price of $9,594,415. So that's the amount of cash we received, so we'll debit cash. Now the whole $10 million needs to be paid back to the bondholder at the end of the bond term. So they know they're going to get a full $10 million back, even though they're only investing $9,594,000. The difference between the two is a discount on bonds payable. The discount is a contra bonds payable account. Basically, the discount is going to be netted with the bonds payable in the liability section on the balance sheet. And so that is the issuance of the bonds at a discount. Now we are going to prepare two interest payments. Now, these are 7% bonds, and there's two interest payments a year. So the first amount of cash that's going to be paid for interest is as follows. The principal of the bond, which is $10 million, times the annual interest rate, which is 7%, times the time, a half a year. So if you take 10 million times 7% times half a year, that's where you get your $350,000. However, that's not all we have to do. We actually also have to amortize the discount. Effectively, we need to make the discount balance go down to zero by the end of the bond term. Well, how long is this bond? This bond is for 5 years. And each year there are two interest payment dates. So if we take 5 years times 2 interest payment dates, that's a total of 10 interest payments. So to amortize this bond of $405,585, we will divide that among 10 interest payment dates, and the result is $40,559 will be the amortization of the discount. If the discount has a debit balance, as you see in Journal Entry 1, to amortize it, we will credit the discount account. Adding up the cash payment plus the amortization of the discount will give you the interest expense. You can see that the interest expense is actually higher than the cash payout to the bondholders. And the reason for that is because that discount of $405,000 is effectively extra interest expense over the life of the bond. Okay, so that is exercise 11-3. Part B basically says, determine the amount of the bond interest expense for the year. Well, it's the $390,559 times 2. for a total of $781,118. What is that? It's the actual cash payments made to the bondholders plus 2 times 2 interest payment dates worth of amortization of the discount. Okay, exercise 4 is similar to exercise 3, but the difference is with exercise 4, we are going to sell the bonds at a premium. Basically, the interest rate that the market is giving is going to be less than the interest rate of the bond. So think about that. If we are giving more interest than everybody else in the market, we're going to have a line out the door to buy our bonds. So we are in a position where we can sell the bonds at even a greater amount, a premium, above and beyond the face value. Okay, so looking at the details here in exercise 4, we have a company, Smiley Corporation. They repair products to equipment manufacturers. On April 1st of year 1, Smiley issued $20 million of 5-year 9% bonds at a market rate of 8%. So once again, our bond rate, 9%, is greater than the market rate of 8%. Therefore, we can sell the bonds at an amount greater than the face value, at a premium. So the amount of cash we received, as the author says here, is we received cash of $20,811,000 and $811,010. Now, the liability is not that full amount. At the end of the bond term, we only have to pay back the face amount, or $20 million. So we will credit bond payable for $20 million. The difference in the cash received and the bond payable in this case, since we received more cash than the liability, the difference is called a premium on bonds payable. The premium will be added to the bonds payable, and the two together will be recorded as a liability in the balance sheet. And the amortization of the premium is what we will do when we record the interest expense. So first, to figure out the cash payment for interest for the bondholders, we have calculated $900,000. How did we do that? We're going to use our interest formula, which is principal of $20 million times interest rate of 9% times time, basically a half a year. So if you take $20 million times 9% times 1/2, you will get $900,000. But that's not going to be the interest expense because we have to amortize the premium. The premium is $811,010, and this is, if I read correctly, this is a 5-year bond, and it pays interest to 2 times a year. So 5 times 2, that means there are 10 interest payment dates. If we take the $811,010 divided by 10, the amortization for each period will be $81,101. All right, and so since the premium has a credit balance, we will amortize it by debiting it. So the difference between the cash payment of $900,000 and the premium amortization of $81,101 is going to be, the result will be your interest expense. You can see here the interest expense is less than the cash payment. That is because the extra added premium amount that we received when we sold the bonds is actually a reduction of the interest expense over the life of the bonds. So exercise 3 and 4 are examples of us selling bonds. We can sell bonds, of course, at the exact face value, or we can sell bonds at a premium or a discount. Next, I want to show you where we can actually sell bonds. So not only do we sell bonds, let me back up. We can sell bonds, but we can also redeem bonds. Bond redemption. Basically, what this means is we can call back the bonds from the bondholders and pay out the bondholders earlier than the end of the bond. That is called a callable bond, a callable feature. And usually there's a set price of what we can call the bonds at. So let's take a look at exercise 5. We have Hoover Corp. They're a wholesaler of music equipment. They issued $30 million of 20-year 8% callable bonds on March 1st of year 1. So the issuance of the bonds, they were issued at par value, meaning no premium, no discount. So we will receive cash, the company does, debit cash, $30 million, and we're going to credit bonds payable. 6 months later, we will write an interest check to the bondholders. And the interest is calculated as principal of $30 million times interest rate of 8% times the time, which is a half a year. If you do the math, that works out to $1.2 million. Debit interest expense, credit cash. Now, year 3, on September 1st, we called the bonds at 101.5. What does 101.5 mean? That means 101.5% of the face value. That's what we actually had to pay the bondholders for paying them off early. So if you take the principal of $30 million and you multiply it by 1.015, you are going to get this amount. And this is the amount we need to pay to the bondholders. $30,450,000. Now remember, how much was the bond payable? It was only $30 million, so we're going to get rid of the liability with a debit of $30 million. But you can clearly see we paid out more cash than what the liability was. The difference is a loss on the redemption of the bond. Well, the difference can be either way. It could be a gain or a loss. In this case, it's a loss because I'm missing a debit. Now the next example, next exercise, exercise 6, also a callable bond, but instead of calling the bonds at 101.5, you're going to see in a few moments we're going to call the bond at 99, and we're going to go through that in a few seconds. So May 1, we actually issue the bonds at par value, meaning no premium, no discount. We sold $18 million bonds, so we're going to increase the cash account with a debit, and we'll increase our bond payable account with a credit. 6 months later, we're going to make our first interest payment to our bondholders, and the interest check is for $360,000. How do we calculate that? Principal of $18 million times interest rate of 4% times the time, half a year. If you do the math, that works out to $360,000. Debit interest expense, credit cash. And of course, you do that every 6 months. Now it says in year 5, we actually called the bonds at 99. And that was listed in the agreement. The bond agreement says the callable feature will be 99. So we're going to take the face amount and multiply it by 99%, which is 0.99. That means we actually need to pay out cash of $17,820,000 to pay back the bondholders. How much was the payable for? It was for $18 million, so I will debit the bond payable for $18 million. But I only had to pay him out $17,820,000. The difference is a missing credit, and that is actually the gain on the redemption of the bonds. All right, so you can see when we call bonds, it could be called at a gain, it could be called at a loss. So these are some very good exercises, and learning a lot about issuing bonds at a premium, issuing bonds at a discount, amortizing that premium or discount while making the cash interest payments to the bondholders, and of course calling the bonds at either a gain or a loss. And we're going to go through one more homework problem here, and this is problem 11-3A, and it's really more of the same, but I want to make sure that you are understanding all of this. So if we go to problem 11-3A, you will find various transactions over a 3-year period dealing with bonds. So first, July 1. The company issued $74 million of 20-year 11% callable bonds dated July 1, year 1, at a market rate of 13%. Let's just dig into that sentence so we understand it. We issued $74 million of bonds, so we know the bond payable is going to be a credit of $74 million. The bond interest rate is 11%, but the market rate is 13%. Since the market is higher than what we are willing to pay in interest, the only way for us to sell our bonds is to sell them at a discount. And it states here that we issued them at a discount of $63,532,267. So that will be our debit to the cash account for that amount. The difference between the cash received and the actual liability, in this case, is a discount. We actually sold it for less than the face value. That discount, once again, is a contra bond payable account. It will be netted against the bonds payable and reported in the liability section on the balance sheet. 6 months later, we paid the semi-annual interest on the bonds, and the interest, which is right here, $4,070,000. We're going to use our interest formula, which is principal of $74 million times interest rate of 11% times time, which is a half a year. And if you work out the math, it's $4,070,000. In addition to recording the cash payment to the bondholders, the discount of $10,467,000 will need to be amortized. And it is a 20-year note, 20-year bond, excuse me, and it pays interest 2 times a year. So 20 years times 2 times a year equals 40. There are 40 interest payment dates. If I take the $10,467,733 and I divide it by 40, that will be the amount of my discount. So if the discount has a debit balance, I will amortize it by crediting the discount account. The sum of the cash plus the amortization of the discount equals our interest expense for the period. You can see we do the same thing. Well, I guess this is the close of year 1, so we'll close our interest expense out with a credit. And remember, it gets closed out to this account called income summary. Now year 2 rolls around. You could see the journal entry on June 30th of year 2 is exactly the same as the journal entry on December 31st of year 1. And December 31st of year 2 is exactly the same as the journal entry on the first 2 interest payment dates. It's basically the same journal entry every single interest payment date for 40 times. And then last but not least, in year 3, we were able to, it says here, we were able to call the bonds at 98. So if the bond face value is $74 million, we will multiply it by 98%, and that is the amount of cash that we actually need to pay to redeem the bonds or call the bonds. And I've highlighted it here, $72,520,000. Well, we got rid of the bonds payable, so we will debit the bonds payable of $74 million. Now we also have this discount. Remember, the discount had an original balance of $10,467,733. But what did we do? We reduced it by $261,000 on December 31st, $261,000 again on June 30th of year 2, $261,000 again on December 31st of year 2, and finally on June 30th, we are amortizing the bond. So if we do the math, this was the original carrying value, $63,532,000. Well, let me do it this way. If you take your $10,467,733, let's do the math. $10,467,733. I will subtract out $261,000 $261,693 amortization on December 31st, minus $261,693 amortization in June 30th, year 2, minus $261,693 amortization on December 31st, year 2, and then, of course, $261,693 on June 30th amortization, which is actually not shown here. And if you followed me through, I apologize for that, but here's the net balance in the discount account, which once again is the original amount, $10,467,000, minus all of the amounts that we've amortized it. So if it had a debit balance of $9,420,000, I will get rid of it with a credit. And now I am missing this debit to balance the journal entry. That missing debit is a loss on the redemption of the bonds. If there was a missing credit, it would have been a gain on the sale of the bonds. So a lot of things going on here in this chapter, mostly related to bonds payable, buying and, or I should say selling bonds payable at a premium, at a discount, at face value, amortizing those premiums and discounts, and of course selling the bonds or calling the bonds from the bondholders.